Mr. Benny invested $20,000 in a laundromat. 3 years later, he was making $3 million, and he'd never washed a single item of clothing in his life. At first, Mr. Benny knew nothing about laundromats. He was just looking for a business that would run itself, without him, without employees, and without customers to worry about managing. A laundromat seemed perfect. People arrived, paid in cash, and the machine did everything. So Mr. Benny decided to rent a space and bought 10 machines. Mr. Benny opened his first laundromat, and the first month was a disaster. Machine number 4 broke down, a pipe burst, and the place flooded. Mr. Benny received the plumber's bill, which cost him $4,000. Mr. Benny was furious, but he didn't panic because he had set up a corporation. In a corporation, all business expenses are deductible from profits. So if the corporation earns $10,000 and spends $4,000 on repairs, it is only taxed on $6,000, not on the $10,000. So this $4,000 plumber's bill, the government absorbs part of it without realizing it. Mr. Benny pays the bill, but not the whole thing. To increase his revenue, Mr. Benny installs a vending machine in the corner of the laundromat. Mr. Benny is clever because he only puts non-perishable products in it, like laundry detergent. These are products that last for years on the shelf and that customers buy exactly when they need them. The margin is 100. 106 months later, Mr. Benny checks his account. The laundromat has generated $30,000 in net cash flow. But Mr. Benny doesn't touch this money because he uses it to sign the lease for a second laundromat. Mr. Benny is ingenious. He bought one business with the money from another business, which means his personal savings remain intact. So Mr. Benny does the only logical thing. He opens 1/3 and then 1/10. Now Mr. Benny makes $50,000 net per month, or about $600,000 a year with 0 employees and 0 customers to manage. The money goes into Mr. Benny bank account even when he's in bed since the laundromats are open 24/7. The taxman calls it passive income. Mr. Benny calls it a good day. Mr. Benny made $1 million this year. The government called and told Mr. Benny, "You owe us $400,000. Mr. Benny hung up and called his accountant because Mr. Benny was smart. Mr. Benny created a holding company. A holding company is just a company that owns another company. The money goes into it, and as long as it doesn't come out, Mr. Benny, money isn't taxed. Then Mr. Benny paid himself a tiny salary of $2,000 a month because taxes are calculated on what Mr. Benny takes in his pocket, not on what the company earns. The rest, Mr. Benny took it out as a dividend. Dividends are the share of profits that the company pays back to its owner, and that's taxed 2 times less than a normal salary. Then Mr. Benny listed all his business expenses: phone car, meals, everything that keeps the company running because that's deducted from the profits, so less reported profits means less tax to pay and to finish. Mr. Benny set up his holding in Ireland because Mr. Benny did his research, and Ireland is a country that decided to attract businesses by making them pay very little tax. Apple does it, Google does it, and now Mr. Benny too. The government called Mr. Benny back and apologized because they did their math wrong this time. Mr. Benny owes $47,000 to the government instead of $400,000. Mr. Benny is happy. Mr. Benny earns more money than everyone around him. Yet when the bank looks at his personal account, it almost thinks he's broke. No villa in his name, no Ferrari, no big salary, nothing. That's exactly what Mr. Benny wanted, because one day, Mr. Benny discovers one thing that rich people understand very early. Real power isn't what you own. It's what you control. Most people buy everything directly in their own name: house, car, savings. But the problem is, if one day they get into debt, a divorce, or a lawsuit, everything can disappear. So Mr. Benny does the opposite. He creates a company, then he has the apartments bought by that company so legally, the assets no longer belong to Mr. Benny, they belong to a company, and that company controls everything. But Mr. Benny gets even smarter. He creates a second company above the first, a holding company, a parent company that takes the money from the other company's result. The money moves inside the system, almost untouchable. So with much fewer taxes, and while everyone thinks Mr. Benny earns little, his companies keep getting richer. Mr. Benny just pays himself a small salary, the minimum to live on. Because he understood one thing: rich people don't put their money in their own name. They build structures that others don't even see.